Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is normally a bi-weekly review and preview of all the market's key events and trading opportunities. So while I just let you look at the disclaimer, I'll just run through some of the key objectives of this webinar. We think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term technicals or themes that increase or decrease in importance over time. Our goal generally is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way. And you can write them in the box, or hopefully I'll address them as soon as possible, or at least after the webinar finishes. Okay, this is the final webinar of the year. It's been great speaking to you and trying to get across all the things that we see, all these themes, all these drivers of markets, which hopefully you can understand and get a greater understanding really of how markets work and where they're going potentially in the future. So for this final webinar of the year, we'll look at equities initially, and we'll look at their 2022 past, so what's been happening this year, of a few of the key drivers, probably three key drivers that we see, and then we'll look at an outlook for 2023 for equities. We'll also then, as many of you know, we'll look at some of the technicals on the major US Wall Street indices, so the S&P, the NASDAQ, the Dow. We'll then focus on two key areas that we see going forward for next year around the economy. So that's to do with recession talk and inflation. Of course, they have been key drivers already, but we see those pushing into next year. We'll briefly then look at central banks and their positioning as we go into 2023, before then wrapping up with a look at the dollar and some of the key major currency pairs, hopefully finishing up with dollar yen, which has of course been hitting the headlines in the last few days. Really massive early shock change, if you like, by the Bank of Japan, tweaking its yield curve control policy, and we'll look at some of the implications for that, for the yen, potentially for other currencies as well, going into the new year. So even in this quiet period, that was a shock to the system, really. Governor Kuroda has, in his time, in his near decade tenure of or at the Bank of Japan, has surprised markets on numerous occasions, but this was another one to add to that list, really. Okay, really markets at the moment, major currencies little changed for the most part. Kiwi dollar sold off 0.7% or so. Sterling as well in cable down 0.5% or so, but generally little change for the other major currencies. The yen taking a breather really after, as we said, the central bank dropping that festive bombshell on markets yesterday. There's not much doubt really that the timing of the Bank of Japan's tweak to its policy was done really for maximum effect, while really the markets are in holiday mode. Liquidity is quite thin, and this really grabbed the headlines. Equities really finding some relief yesterday briefly after Wall Street arrested 4 straight days of declines in trading. Gains were very mild, but at least green for the most part, except for the tech-laden NASDAQ, which eked out a small loss. But futures, US futures that is, are pointing to green start, a positive start in the US session in a couple of hours time. NASDAQ actually up over 0.5%, showing the futures at the moment. So we shall see when markets open, as I say, in a few hours. So just looking back to 2022, the year as a whole, really, market volatility has been exacerbated by external events, and really changing expectations around the likely size and speed of monetary policy tightening. And really, these rising levels of uncertainty for investors have been brought on by three main themes. So the first one's persistently high inflation. That's the result of demand, of course, for goods and services outpacing supply. And secondly, we've had a major change in monetary policy by the US Fed. And despite policy moves by the central banks really to ease economic growth, which has not been seen in decades, higher inflation, really historically high inflation, really endures. And it's interesting that some of the setbacks we've seen, especially in the summertime, reflected that realization that the Fed especially was not pivoting and would have to raise rates further and maintain those hikes potentially well into next year. Final key theme really was the economic fallout from Russia's invasion of Ukraine. It's kind of self-explanatory, that theme, and it has really sort of boosted commodity prices and of course all around the energy crisis, which has sort of engulfed Europe especially. But it's also, of course, snagged up those supply chains, and then meant that price pressures have remained sticky, remained high for really much longer than we thought, and the policymakers have thought, which is key. Of course, there are other themes and stories which gained importance over time. For example, the continued uncertainty over lockdowns increased the presence of COVID-19, of course, and that especially relates to China and its zero COVID policy, which we've seen for most of the year, and is, of course, potentially being relaxed as we move into next year. And also there was that contentious election season in the US. But generally, it's really central banks that have definitely struggled to give consistent forward guidance, consistent messaging really around where they saw or where they saw going forward, which generally they were trying to do at each central bank meeting, but the consistency of that message was difficult because of the volatility, because of the uncertainty which was unfolding. And confusion in markets, really, that's driven sharp swings in both bond yields, which of course we've all been looking at this year with rising interest rates, and also then they have destabilized equity markets. And you can see then on this graphic really equity price action on the S&P, the benchmark US index. Price action has been extremely volatile really. It's been a turbulent year with markets up and down, and you can see that simply on this bar chart. There's many ways, of course, and we'll look at the chart, the technicals for the S&P, but just simply on this bar chart, you can see how up and down the market has been. And that's really reflected in investors' battles between this ongoing fear and then flashes of hope that tough talking central banks might be ready to ease their rate hike campaign. It's this pivot idea which has really entered the sort of lexicon, if you like, financial lexicon of markets. There's been so many sort of new words, if you like, over the last few years, lots of acronyms, if you remember, buy the dip. Lots of sort of alphabet of different things, different policy measures that we've seen over the last few years. And then also, of course, we've had bond yields, we've had yield curve inversion, if you like, and then also then this pivot idea. Pivots, kind of probably, I've not probably heard it before this year really, and simply because we haven't had a hiking cycle for so many years. So the pivot idea is obviously around one where primarily the Fed stops hiking and then starts cutting rates. And that's kind of dominated the narrative, especially recently, after the Fed, of course, kicked off the most aggressive, or one of the most aggressive periods of hiking in many decades, and that kicked off in March. But now, of course, with inflation remaining elevated, as we've mentioned, and the Fed intent on batting it down with higher interest rates, Equity bounces are increasingly being seen as bear market rallies rather than the start of a new bull trend. And it's interesting really that these kind of speed bumps like this, they're certainly not uncommon on the path to, well, solid longer term returns, or in fact, these kind of rallies are often seen as long-term bear markets. So if we just go to the chart, actually now I think is a good time to do that. Sorry, just bear with me. So this is the S&P weekly chart actually. And as I say, we've been up and down a lot. You can see from that bar chart, and you can see obviously on the the candlestick chart. This is the weekly chart. As I say, we've been in and out of bear market territory repeatedly this year. So bear market territory, if you remember, that's one defined as a decline of 20% or more. And the S&P, well, it's bounced from very near bear market lows in April, which you can see if I just pull out the low from April. So from bear market lows in April, then that rally petered out after a rebound of nearly 10% with a strong bullish move, especially in the last week of May that you can see here. So those were the lows in April. Then we had that strong bull market up sort of 10% or so. So obviously not definition of a bull market, but a strong 10% move, bullish move, sorry, in the last week of May. And many really were questioning some of these acronyms, so the buy the dip acronym and that kind of thing, whether they were still valid during that month. But certainly the rally was positive. Before then, again, we hit new bear market lows in the first half, the latter part of the first half of 2022 this year. And markets have sort of continued that roller coaster ride since then. So we got new lows for the year. They were made in June, that you can see there, before another sharp bounce of close to 20%. And we got 4 consecutive weeks of gains in that strong summer rally that we talked about. Again, we pushed back down. We had a few weeks, 3 weeks there of selling. And then sellers really emerged in mid-August as the market hit real fresh lows for the year in October. And investors' fears really rose there of fears around the recession. And at that point in time, I've actually drawn it on there, the market was down over 27.5% from the highs at the start of the year. So down 27.5%. Then before we got this rally into the end of November, and you can see another strong bounce there. Before then, we've sort of just had a couple of weeks of selling pressure. Interesting, we kind of focus on this balancing act therefore for the Fed, the idea of this hard or soft landing being a key driver. Monetary policy is intended to slow the economy as a way to temper the inflation threat, but without pushing the nation or the US, whichever country, into recession. And that is going to be key going forward, as we know, this idea of the Fed threading the needle, if you like, and really potentially being relatively happy with potentially a softer landing, if you like. But the economy through 2022, through this year, certainly slowed. GDP falling in the first and second quarters before that first positive reading of the year in the third quarter. Intriguingly as well for us, despite the Fed's efforts to pump the brakes on the economy, jobs growth remains impressive. Non-farm payroll figures grown by an average of 392,000. That does compare with 562 average last year, but still very impressive jobs growth for the year. And really that is going to be a key feature, we think, of markets going forward. Potentially, if inflation is coming down, then markets potentially and the Fed will focus on the job and labour market. Just looking then going forward for 2023, really for equities, market fundamentals such as corporate revenue earnings will be a concern into this slowing economy, and they will have an impact on corporate earnings. And there are certainly a number of questions about how far earnings can go. Apologies, just checking something out here. Yes, so how far earnings can go, and that will then sway GDP being more positive or negative going forward. Most of Wall Street, really, they're suggesting that recessions will remain or kick off in Europe and the US at the start of 2023. Interestingly, sort of equity internals point to lower probabilities of this. In Europe, 80% US, just 41%, I think, was the last sort of internals are looked at to see about potential US recession. And falling bond yields, certainly they will help valuations, and the overall market therefore could potentially trough in the second quarter of next year as the Fed pauses its rate hike cycle. Generally though, just looking at market volatility as well, if we do get that move that we've seen, the trough in the second quarter, then volatility is set to rise potentially probably in the first half of next year, as the global economy kind of adjusts to the next phase, and potentially that volatility. It's interesting, we think the central banks talking about for their forward guidance this year, well, next year they'll probably reduce that forward guidance potentially quite significantly in 2023, as it essentially gives them more flexibility in their next steps. So more data dependent central banks means financial markets will be less spoon fed on the future direction of monetary policy, which then increases the scope for surprises and volatility going forward. As we mentioned, or just before actually we get to the two economic areas of recession and inflation again, just on the technicals, then we can see on the weekly chart the S&P, key is this trend line resistance from those highs at the start of the year, touched a couple of points, 3 points so far, so really strengthening that idea that this dotted line is very solid resistance to any upside. You can see most recently, and especially last week, we did poke above that line, but sadly closed much lower below it. So again, reinforcing the strength of that resistance. So we're definitely going to be keeping an eye on that. That near-term sort of trend line support has been broken, it looks like. So it looks like we're rolling over again, and you can see this just wave of sort of bear market rallies, and then a sell-offs once we hit that trend line. So key will be that trend line, interestingly around the 4,000 level. You can see there, always a key psychological level, if you like. We've kept then some of these fib levels. Fib levels are from so the pandemic low that you can see there up to the high of this year. And we're trading now just around that 38.2 level, so just above 3,800. So that may offer support, initial support for the S&P. If we do break below that, then you've got this 200-week moving average at 3,662, you can see there. And then the halfway point of the rally from the pandemic lows is just below 3,500. So some big figures, if you like, some rounded numbers, 3,800 and then 3,500 being key levels and just sort of in the middle of that is the 200-week moving average, as we said, at 3662. But 3,500 certainly, if we do get this move lower that many are expecting on Wall Street, especially this trough in the second quarter, then 3,500 is a key level. You can see there the low from October was 34.91. We bounced off that, so 3,500, that halfway point of the pandemic rally, if you like, and obviously a key psychological level as well at 3,500. Just on the NASDAQ 100, some technicals. Again, you can see, if I just take off, I like the Keltner channels, but you might not be aware of those. You can see again this trend line. Let me just make it a bit thicker and more obvious. So you can see again, tapped a couple of times. So that reinforces the idea of the strength of that resistance, if you like. And again, you can see last week we tapped it, but then moved lower. We've got the mid-June low at 11,037, so just above 11,000 as sort of key support, because you can see we sort of tracked below it, but then sort of held above it through October and November. So potentially, if we do lose that key support level, then we're looking at the cycle low at 10,440 as a target for bears. This is in the NASDAQ. The Dow technicals, really interesting. Again, for the weekly, if we just expand that, we've had a much bigger rally for the Dow, up over 20% it was at one point from those October lows, and then we just rolled over, similar to the other indices on Wall Street, but holding up slightly better due to the nature of the stocks of the companies in the index. Obviously much less a number of stocks, only 30, but more old economy, less growth, less tech in the Dow. So that's seen it perform better as we've seen rising interest rates. Of course, growth stocks especially don't like the rising interest rate environment. So the Dow has performed better relatively compared to especially the NASDAQ. But you can see struggling again at that August high, the August high at 34,281, and you can see we sort of popped above there last week as well. Kind of looked as though that 100-week moving average had that grey line there had held as support, but it didn't quite work out that way, and we've dipped below there again. The light blue line is the 50-week moving average at 32,700 or so. If we do drop below there, then it looks as though we're rolling over really, and sort of next decent sort of level would be 30,257, which is a 200-week moving average. If we just go to the daily, you can see quite a confluence really of moving averages there, the 50-day, the 200-day, and then the 100-day below that. But the 200-day moving average, 32,451, sort of key support around here, just above 32,000, then 32,200 up to 32,500 or so. Key levels of support for the Dow will be interesting. If we do lose those, or they act as support and we bounce back and we move back up to 34,000 for the Dow. Okay, we said we'd mention just two areas in the economy that we think are important, of course, for going forward. We've got a chart here which just shows us where we've come from. Obviously, the light blue line, the Fed funds target rate. You can see how quickly we've moved up from sort of near zero up to 4.5% where we are now. And then you can see also PCE inflation. We actually get that figure out on Friday. Fed's favored gauge of price pressures, really, of inflation. And you can see how high that is still, even though it's come off that sort of 7% marker. We're still historically at very high levels, around 6% or so for the core PCE. So just giving you a flavour of really where we are we want to talk about recession and inflation. Recession, firstly, history kind of suggests that inflation above 5% is a recipe for recession. And this time around, the Fed has made, of course, we can see these dramatic rate moves in a very short space of time to catch up really from its late start in addressing inflation. And Fed actions, they historically affect the economy with long and variable lags. So the economic consequences of this hiking cycle, really, we kind of think are yet to be fully felt. And Fed Chair Powell has touched on that recently about the lagged effects. And potentially that means then, as we've seen, a slowing up in the pace of rate hikes by the Fed. Any recession potentially, well, how's that going to look? It could look relatively shallow in depth and duration, and the key reason for that is the consumer, the US consumer, which accounts for nearly 70% of US GDP. The consumer remains in relatively good shape, doesn't have a high debt burden and all balance sheets to repair, unlike that more attractive recession during 2008, the great financial crisis. And in fact, I think BlackRock have calculated that the average recession in the post-World War II era anyways has lasted just 10 months, and expansions meanwhile have averaged 5 years. And equity returns in the years following recessions historically have been positive. So just moving on then to inflation. Will be again a key driver for markets. Headline US CPI, so we're moving away from core PCI just for the minute, but headline core CPI looks just not on this chart, but just on the headline, looks to have peaked at 9.1% in June. We had those figures recently. That's the latest reading being 7.1% in November. That was the biggest yearly drop since April 2020. And you can see here on this chart then, interesting chart. So core CPI, sorry, is excludes food and energy. They're volatile elements. But this chart produced by Bloomberg, that also excludes shelter, which is a big component, over 30%, I think around 30% of the CPI basket. So if you exclude those three elements, then the underlying figure is around 5%, and you can see has dropped sharply from above 7% when you strip out those three elements, but again is still historically high. So key, of course, will be, and we keep on saying this, we said it last time as well, a couple of weeks ago, just how sticky these prices are, or how quickly they will fall. Because certainly despite falls in commodity prices and shipping rates, plus of course we've seen weakening growth, that focus will still be on how quickly these prices come down. There's kind of two schools of thought here. So while central banks have jacked up interest rates, some say there's not a lot of evidence that inflation is anywhere near defeated. So aside from these charts, then you have excess household savings from all the fiscal handouts during COVID, and you've still got low unemployment that is, continues to support this consumer demand. And inflation in much of the world as well has broadened out, in fact, into wages and services. So there is then as well a wide range of factors that can also work potentially against a quicker fall in prices. These are kind of wider sort of themes, but deglobalization, demographics, climate change, they all sort of possibly point to a less or not a speedy retreat in prices potentially going forward. And you also have to bear in mind, we think this is an interesting idea about governments may also be more tolerant to higher inflation as a way to reduce that real value of high public debt, the like of which we've sort of not seen in the US, for example, after World War II, so going way back to that. On the flip side, the second school of thought, as we mentioned, anecdotal data is moving more quickly, really. So housing demand and prices are easing. Consumer confidence in the US is waning really, and retail sales growth is showing signs of stalling. So for central banks, really, it's instrumental in this, as they can always, central banks will be instrumental in this. Of course, they can always bring inflation down. It's just a matter of how much growth they're willing to sacrifice. And as we mentioned earlier, it's about trying to thread this needle to really a soft landing, really. We go back to that. A hard landing would be a hard recession. Soft landing, obviously, much more preferable, and wouldn't be this sort of long-lasting idea of very weak economic activity and demand really being crunched, which is what may happen if central banks tighten too fast, or potentially just keep rates for too long. And this is the key question really going forward. Okay, for G10 central banks generally, then, where we've seen this sort of slightly synchronous, if you like, hiking path, now that's kind of less so. Each major central bank really faces its own specific issues peculiar to its regions and the pressures they're facing. So for the Fed, in fact, we just got this jobs chart here that you can see, which really shows how quickly or how sharply we've come back, and this steady pace of solid job gains. Really, as I kind of mentioned, potentially if we see CPI inflation data moving lower, if that downtrend is becoming entrenched, then the Fed, the markets especially, can then set its sights on the labour market. And interestingly, then near term, a slowdown in job growth over the coming months, potentially, that triggers then this further step down to 25 basis point increases for the Fed, certainly at its first meeting next year, which is at the start of February. And then potentially as jobs growth trends towards, say, 100,000 on the non-farm payroll headline number, then that will have an impact, on potentially much less interest rate hikes going forward, and the peak sort of being below that 5% mark. I think what I'll do here is just pull up one of our charts that we've used a lot over the last few months, which is this CME Fed Watch tool that you can see here. Hopefully you've may have been using this just to guide your ideas of where the Fed is going. But essentially, yes, for the major central bank in the world, the Fed, the FOMC, of course, the debate over the peak for Fed funds and how quickly rate cuts will follow kind of rages on, this debate. In the near term, the updated economic forecast of the FOMC from last week's meeting made clear that the committee remains resolute in their determination to fight inflation. They see a peak of 5.1% for Fed funds in 2023 to be followed only by modest cuts in 2024. That's according to the dot plots, if you remember. That's the projections of the Fed officials. Essentially, their assessment of price risks remains tilted to the upside. But still, in the press conference, if you remember, Chair Powell made clear that the Fed's decisions would actually be data dependent, and materially reduced his comments regarding financial conditions. And certainly on that point, whereas getting term interest rates well into contractionary territory has been the Fed's focus for the past year, we think kind of in the press conference, Powell's response to the question on financial conditions was really interesting and focused on Fed funds on the overnight policy rate. So really, arguably, this points to a recognition that late in the tightening cycle, the market inevitably will price in the timing and scale of rate cuts to come. So just looking at this Fed Watch tool. Obviously, this is futures markets pricing in what they see. You can see then for February, in the near term anyway, high chance of just a 25 basis point move, 27% chance of a 50 basis point move. And then as we go through the year, you can see that we really get to May now being the probably the top of the cycle. That's given a 48% chance of rates being between 4.75% and 5%. And if we just drop down here, you can see that's kind of doubled from a month ago. And if you take us, if we go back a month, then you can see that switched where markets really thought rates would be above 5 to 5 or be in the 5 to 5.25 range. You can see there they were given a 42% chance, just a 24% chance. That is now. So we've sort of flipped. You can see from being above 5 to below 5 potentially, and peaking around May or so. Before then we get cuts. So interesting flip there that the markets have done. And we'll just get on to the sort of difference between the Fed and markets just very briefly shortly. But it's all about managing these expectations, really getting inflation back to target, whilst doing so without a lasting hit to activity. Pricing we've talked about then for the February meeting, and really in the near term anyway, a lot will depend on the data flow, as we said, the Fed being data dependent, especially now. So US non-farm payrolls, that's on the 7th of January. And then we get the US CPI data on the 13th of January. So they really jump out as key data points which will influence that call around the February 25 basis point move, or potentially higher 50%, 50 basis points, or even yes, depending on the outcome of the data. Just looking at other central banks then, otherwise in other economies, really the risk of not doing enough may well also happen, despite experiencing, say, a strong prolonged recession, as could be the case for the Bank of England in the UK. Other central banks like the RBNZ and the ECB, they're choosing really, it looks like, to over tighten rather than take the risk while the of doing less. While then we also have the policy laggards like the SNB, that's the Swiss National Bank, and of course the Bank of Japan. We'll talk about them a bit later, but again, they don't have the same inflation problems, so are slightly different. Regarding the UK then, we've got to bear in mind the acute labour shortages and what looks like increasingly embedded inflation. That means they, Bank of England, the MPC, have a really difficult task ahead, although it looks like they're going to slow the pace ahead of, say, the Fed, and then ahead of then the ECB. The Eurozone, apparent risks from the energy crisis have diminished slightly, interestingly, in the last few months with the warmer weather, although it's certainly getting colder now in the region. While, of course, that dependence on Russian gas remains a hugely dangerous problem, really. And the fact that the crisis probably isn't deepening as winter sets in, that has probably encouraged the ECB to sound slightly more aggressive. But just wrapping this all up then, before we get to the dollar, interesting, we think that there is this division over the economy, which we've been talking about for some time, really. So that's mainly the markets, think inflation is sort of well under control, or getting to that point of being under control, meaning that central bankers could do much damage if they keep doing what they're doing. While on the other hand, others, which includes really mainly central bankers, believe that the inflationary regime has shifted, and that rising prices could still become entrenched. And it's this idea of, I think one economist put it, immaculate disinflation, that the market believes in, but the Fed at the moment doesn't. So it'll be really interesting, especially in the near next few months, especially how this difference plays out. Don't fight the Fed is something that comes to mind, especially, but the markets are at the moment thinking slightly differently, and that peak rate, for example, in the Fed funds is slightly below 5% at the moment, whereas, of course, the Fed in their dot plot, pointed to a 5.1 percentage peak rate, I think it was. So really interesting to see how this plays out towards the first few months, especially of next year. Okay, we'll go to some charts now. Just bear with me 1 second while I pull up the dollar chart. Anyway, let's talk about the dollar. In the context of a stock market, well, historically, the trough for stocks has tended to come almost exactly at the dollar's peak. So if you're kind of comfortable that the bottom for equities is in, it follows that then we've seen the top for the dollar. But just looking then at the weekly chart, well, after an 18-month bull trend in the greenback, really, FX outlook now becomes slightly less clear. Certainly that most crowded trade of this year has been long dollars, and that really is no more. Positioning now is slightly short, I think, amongst the big players, speculators, when we look at the COP report. And the final quarter really of this year has seen that breakdown in that uptrend. And remember, it was a trend which has been worth around 5% per quarter over the first 9 months of the year. But now we're kind of assuming that central banks can signal that all clear on inflation and then deliver this sort of gentle easing cycle to ensure soft landings. And obviously, as we've just said, the question is, will it be so easy? For the dollar then, if we do get a protracted bear trend, then really there's a sort of a few key things that probably we need. Firstly, the Fed taking a back seat will be key, and a sort of decisive shift in its rhetoric. Then secondly, the flip side to that, of course, is a more attractive global economic environment, and attractive enough to draw funds out of the dollar. And again, if we think about Europe, or think about the global recession idea, then that really doesn't help that reasoning potentially. And then also we kind of got to consider liquidity. So central banks are reducing their balance sheets in quantitative tightening, QT, and that really means lower excess reserves, tighten liquidity, and raises potentially FX volatility. It's good for trading, certainly, but with dollar deposits potentially soon being 5% or at 5% for a dollar deposit rate, then and the dollar also being the most liquid currency, then that plays into a sort of underlying bid, if you like, for USD. Yeah, technically DXY, obviously this basket made up of 6 of its major peers, Europe being the euro being the biggest, weighting by far, around 57% of this basket. You can't always have to remember that key fact. So essentially, if you flip this chart over, then it's kind of similar to the euro dollar chart. But anyway, we can see on the weekly 50-week moving average 104.20, that light blue line, holding as resistance. You've also got the August sort of low around 104.63, potentially being a sort of line of near-term resistance at least. We've marked in here this dotted line here. You can see from the pandemic highs, 102.99, key level for us. So key support if we do move lower. Near term, as I said, we've got 104.20, and then below that 103.44, which was last week's low to contend with. Before then 102.99. We've got some fib levels actually. If we do move then lower, the fib level of this 18-month really rally, but especially this year's rally, the midpoint of that, the 50% mark, is at 101.99. You can see there that thin dotted line, so potentially other strong support below. And then upside, if we do get, say, volatility, geopolitics especially, then a safe haven bid that we see to the dollar, then potentially we've got to break 104.63, and then we get up to sort of 105 levels and above. That's on the DXY. Just for the majors, just quickly get through some of those if we can. Euro dollar. Chart is here. That's the weekly chart. You can see really that short squeeze has helped the most popular currency pair, along with a sharp rally, of course, in equities and bonds. This is markets really shifting to the soft landing scenario, really, in a turn in inflation, the inflation cycle. How long can this last? Well, if the Fed goes to 5% or near enough 5%, and the ECB, even if it's above 3% after that hawkish meeting that we saw last week, will the Fed rate cuts potentially in the second half of next year be enough to weaken the dollar? That is a question for us. And especially if Europe and China are still struggling to grow. We kind of touched upon that earlier. Also for euro dollar, we need to bear in mind energy prices, many predicting higher natural gas and oil prices through next year. And then a tough European winter in 2023 that could hold back euro dollar and its recovery later on in the year in 2023. Also think that the start of quantitative tightening, so the reduction in the ECB's balance sheet signaled for March of next year, that will certainly be worth watching, as really there's a hope that it goes quite smoothly and it doesn't upset peripheral bond markets, and probably we'd look out for headlines on that towards March when QT starts in Europe, and potentially changes to some of the southern European countries' bond markets and how that works out. Technically, we can see then we've got some fib levels in here. Upside at the moment capped by 107.46. That 61.8 fib level of the move down. Potentially that was capped last week as well. We got above there but closed below. As you can see, 107.36 was the high. But 107.46 is that fib level. So the first sort of major resistance. The dotted line there is the pandemic low, so the opposite of the DXY chart, of course, and that comes in around 106.35, so just above where we are at the moment as an initial resistance level. For support, then you've got the halfway point of the move, 105.14, and then the 50-week moving average at 105.08 as well as support. On the daily, well, the 200-day moving average at 103.37, always sort of widely looked at. Not sort of proved that useful, if you can see on the daily, really, for euro dollar. Probably more useful is the 50-day moving average. You can see there, because it's kind of capped to the upside, and then we've broken above that, so may offer some support, but that's sort of down below 103 towards 102, so sort of initial support on the daily is the probably the halfway point, which is at 105.14, and then we go down to the 38.2 fib level at 102.83 as support for euro dollar. But a nice uptrend if we keep this series of higher highs and higher lows, really. In euro dollar. For sterling, just briefly look at that before, if we can, looking at dollar yen. Strong rebound, of course, in this major, after obviously September's government inflicted flash crash, really, at that all-time low 103.56, around there. Of course, now we've got slightly more credible fiscal plans. Softer dollar really helped cable push higher. Going forward, tricky, obviously, most expecting the sterling to weaken. Really, we've got tighter fiscal and monetary policy heading into a recession. Remember, the UK economy expected to contract every quarter next year. Kind of makes UK assets unattractive, especially if the Bank of England kind of calls time on its tightening cycle. Interestingly, cable realized volatility, so that's just a measure of prices, price direction going forward, not direction, but volatility, is now back to levels seen during Brexit. And with liquidity at a premium next year, then potentially the kind of pro-cyclical nature of sterling means it may struggle. Technically, we can see upside capped by sort of 125 level, 124.52, actually that fib level of the move lower for the year. So 124.52, yeah, capping the upside, so first resistance level. And then you've got the 200-day moving average. Will that prove useful? But it tallies with the halfway point of this move lower at 120.52. So a decent level of support there. If we do lose that, then we go down to sort of below 120, and near term probably that November low at 119 or so as near term support. Okay, just moving finally to dollar yen. Amazing move really yesterday. Dollar yen closed down 3.8%. Really, market was drifting off really into a sort of festive slumber, and then the Bank of Japan surprised everyone really by tweaking its yield curve policy. That means it widened the band it allows its 10-year government bond to trade in, plus or minus 0.5% from plus or minus 0.25%. It also unexpectedly announced an increase in bond purchases in Q1 of next year, whilst obviously keeping its policy rate unchanged at negative 0.1%. But it was the surprise tweak, of course, to bond yield curve control policy, which essentially allows for higher longer term interest rates in this current inflationary environment and is aimed at easing some of the costs of prolonged monetary stimulus. This is despite, as we said, the Bank of Japan still officially targeting around 0% as the outright target. Governor Kuroda kind of warned markets that it's not a rate hike, and he pushed back strongly against such speculation, and said further widening of the yield band is not needed. But really, investors, initially expecting this kind of change potentially as his term expired in April of next year. But really then this is potentially encouraging markets to see this as laying the groundwork for more policy normalization into the new year, either under Kuroda or especially under a new governor that we get after April of next year. As I said, the dollar yen closed down, well, 3.8%. That was the fourth biggest decline since the Plaza Accord in 1985. Is this now really a potential pivot by really the last remaining major central bank that has stuck so steadfastly to this ultra loose monetary policy regime that we've seen? Certainly the shock change puts markets on guard really for more possible surprises, as we said, going forward. I think Goldman Sachs have said overnight the Bank of Japan's next move could be removing the negative interest rate, as it puts greater emphasis on the need to enhance market functioning. But whatever happens, it kind of quells speculative positions built up against the yen, and it could also help global economies a little by weakening the dollar. So really interesting times for the yen going forward, potentially a big sea change. I think we talked about the S&B and that sea change, if you remember, way back, about FX intervention and the like, and potentially as well, then this is the last remaining ultra loose central bank potentially changing its policy as well. So for dollar yen, you can see technically, again, if we just pull up the daily, actually, we've got the weekly, we've got the sort of 50-week moving average at 131.75 potentially is holding as support. Then you've also got the July low at 130, is that 132? Oh, sorry, 130.39 potentially as a level of support. If we just go to the daily, you can see, yes, this halfway point of this move higher in dollar yen, that's at 132.70, so we've broken below that, and then potentially we get down to, as we mentioned, well, the 2nd of August low, which is at 130.39. And we did break that last week, actually 130.56, and we're just sort of hovering above that now. So really interesting key levels for dollar yen as we go into the new year. Okay, I think that's all we've got time for now. Hopefully you found that interesting. We will return in the new year, the 2nd week of the new year, I think. So have a great festive period. Happy holidays to you all, and we look forward to speaking to you next time.